Yesterday, silver traded at $91 an ounce in New York. Today, in Shanghai, it hit $104, a $13 gap on the same metal, the same commodity, from one side of the globe to the other. In a functioning market, that is impossible. Arbitrage traders would have closed that gap in seconds. But the gap isn't closing, it's widening. And the banks, they are trapped. Let me make this real. $13 per ounce may not sound like much, but multiplied across millions of ounces, this is enough to make, or break, some of the largest banks on the planet. We're not talking about your average investor. We're talking about institutions that have been betting against silver for decades, selling short and counting on the system to stay normal. And here's the kicker. The paper market, the market we see on screens in New York and London, is completely disconnected from reality. The real price, the price people are actually paying for physical silver, is exploding. In India, buyers are paying $132 per ounce. In Shanghai, even with premium and shipping, the market is red hot at $104. The old rules no longer apply. But the real danger isn't the price itself. It is what this tells us about the system behind it. Because when the banks are trapped and the paper market is lying, your savings, your investments, and the value of money itself are on the line. To understand why this $13 spread is more than just numbers on a screen, we need to step back. Think of the global silver market like a household budget. Every dollar you earn, every dollar you spend, has to balance. Now imagine if someone kept promising money they didn't actually have, checks bouncing everywhere, but people still acted like everything was fine. That's what's been happening in the paper silver market for decades. Banks and financial institutions have been selling paper contracts, futures, ETFs, derivatives, on silver they don't actually hold. They counted on the illusion that the system would stay normal, that physical supply would never run out. And for decades, it worked. The paper price acted like a mirror of reality. Until now. The problem started when physical demand outpaced supply. Countries like China and India, with billions of people and industrial demand that can't be substituted, began hoarding real silver. Vaults in the West emptied, dealers sold out, even mints are backlogged for weeks. And here's the critical part. Shanghai can pay for metal, but it can't come back to the West easily due to export controls. The bridge between paper and physical is gone. If the market you see on your brokerage screen is disconnected from reality, the numbers you trust for your investments, retirement savings, and even your job security could be lying to you. The system is built on an illusion, and illusions can collapse overnight. Now let's look at the numbers, because numbers don't lie. Yesterday, COMEX silver in New York traded at $91 an ounce. That's roughly what it would cost to buy a small gold chain or a high-end gaming laptop per ounce. In Shanghai, the same metal closed at $104 an ounce, about the price of a premium smartwatch. The gap, 13. On a commodity that should be uniform globally, that is unprecedented. In a functioning market, arbitrage traders would swoop in, buy silver in New York, ship it to Shanghai, and pocket the difference. That is how price discrepancies vanish. But the gap isn't closing, it's widening. Why? Because there's no metal left in the West. Vaults are empty. Dealers are sold out. Mints are backlogged for weeks. Even if banks could find silver, new export rules in China trap it once it crosses the border. The bridge is broken. Let's talk about the banks. JP Morgan, HSBC, Scotiabank. These institutions have been shorting silver for years. They profited when the price fell from $30 to $50, $50 to $70. But now they're trapped. Their shorts are underwater at $91 in New York and $104 in Shanghai. And with physical metal unavailable, there's no way for them to cover without driving the price higher and accelerating their losses. They are cornered. Meanwhile, India is paying a staggering $132 per ounce, almost 45% above the COMEX price. The premium isn't a glitch. It's proof of a real physical shortage. People are hoarding. Industrial buyers are desperate, and the market is screaming for metal that simply doesn't exist in the West. Silver is no longer a single global market. It has bifurcated into two realities: the paper market in the West and the physical market in Asia. Yesterday, the CME tried to intervene, raising margin requirements by 15% to force traders to sell and crush the rally. For a few hours, it looked like it might work, but the fundamental shortage overwhelmed the paper manipulation. New York dipped slightly, Shanghai kept climbing. The attempt failed spectacularly, exposing the banks to massive potential losses. Now, look at the broader market. Gold is hitting all-time highs at $4,144 an ounce, more than the cost of a brand new luxury car. U.S. Treasury yields are spiking, meaning investors are fleeing government debt. Bitcoin, despite volatility, is holding above $80,000. Copper, platinum, palladium, everywhere, hard assets are rallying. This isn't random. It's a global vote of no confidence in paper money and the dollar. When the system is breaking, it isn't just silver traders who are at risk. Your 401k, retirement fund, Even the dollar in your wallet could lose value overnight if confidence collapses. Understanding the real market is the difference between being caught off guard or being prepared. Here's the starkest example. India is paying $132 per ounce for silver, Shanghai $104, COMEX $91. If you're holding ETFs or futures priced at $91, you are potentially disconnected from reality. If production bottlenecks continue, shortages intensify, or a crisis hits a bank, the paper price could collapse or skyrocket overnight. That gap isn't just a statistic, it's a warning sign of systemic risk. And it's not just silver. Every industrial metal from copper to platinum is showing similar patterns. Hard assets are rallying because paper markets are under pressure. When physical supply can't meet demand, prices don't just rise, they can overshoot dramatically. And if this spreads to broader commodities or currencies, you're looking at a potential cascade of price shocks that touch every corner of daily life. So what happens next? Where does the silver market go from here, and why should you care? The truth is, no one can predict the exact day or price, but patterns are emerging that we cannot ignore. Short term, in the next few days or weeks, expect extreme volatility. The paper market may fight back, exchanges might raise margins again, banks could attempt to dump massive amounts of contracts to shake out weak hands, prices could temporarily dip in New York to 85 or even 80s. But here's the key, the physical market will not follow. Shanghai will stay above $100, India above $120. Premiums will remain high, because the physical shortage is real and intensifying. Eventually, the tipping point will come. Maybe it's a delivery failure. Maybe a major industrial buyer publicly complains they cannot get the silver they need. Maybe a sovereign wealth fund stands for delivery. Or maybe China announces further restrictions on exports. Whatever it is, it will act as a catalyst, snapping the paper market back to reality in a violent move. Potentially $10, $20, or even $30 in a single session. Overnight, the market will realize what Shanghai and India have been signaling all along. The real price isn't $91, it is whatever the physical market demands. Some analysts project silver could reach $375 per ounce by 2028. But consider this, $104 today in Shanghai seemed impossible just 6 months ago. $91 in New York 3 months ago was unimaginable. If industrial buyers, sovereign funds, and retail demand continue to compete for scarce physical supply, there's no ceiling. Prices could surge to $400, $500, even $600 per ounce in extreme scenarios. Sounds insane? So did $104 a few months ago. And it's not just silver. This is a systemic signal, a global shift out of paper money and into tangible, scarce assets. Gold at $4,644, Bitcoin holding above $80,000, farmland and real estate hitting record prices. Confidence in fiat currency is eroding, and the consequences extend beyond traders. Your savings, your retirement, and the purchasing power of the dollar are all at stake. This is the greatest wealth transfer in modern history, and it is happening right now. Being positioned on the right side of it could protect your money. Being on the wrong side could mean watching opportunity and real wealth slip away. The $13 spread between New York and Shanghai isn't just a market anomaly, it's a smoking gun. It proves that paper markets have lost control, that banks are trapped, and that physical demand is taking over. The question isn't if the paper market will break. It's when and how you will respond. When the market snaps, when reality overtakes paper illusions, which side will you be on? Watching from the sidelines or prepared for the next chapter in the most dramatic shift in global finance in decades? Numbers don't lie, but markets do. Stay aware, stay informed, and understand that the era of paper silver is ending. The age of physical dominance has begun. Watch closely, because the next move could happen at any second.